Hello everybody, and how are we all? And welcome to all of you wherever you are in the world. My name is Julian McCree, and today we're going to, rather than having our Trader Cafe or chat with Jules, we're going to do a bit of a masterclass. So I'm going to speak for about 90 minutes or so. We'll have a little bit of break in between. And the idea today is to hopefully educate a little bit more about developing your trading edge. And, this is what the point of this series is. And as part of that, from time to time, we just do a bit of a teach-in. So today is going to be me chatting for most of the time. There's no guest today. I'm really happy and very keen on taking as many questions as I possibly can. But obviously today is going to be a little bit about me talking more, and there just being hopefully feedback and any questions for you guys if you don't understand, or if you'd like to at the end ask me anything else about any part of the presentation, or in fact any other question that you'd like to ask about trading. So what I'm going to do now is I'll just set this up and start to share the screen. So hopefully this works. So just give me 2 seconds just while I get this up and running on the slides, and I will be with you momentarily. Just give me 2 seconds, folks. So hopefully everybody can see that. Could somebody possibly do me a favor and just tell me if they can see me? That would be fantastic. Thank you very much. Brilliant. Okay, cool. Like I said, look, this is for me really about developing your edge. My role here is to hopefully try and educate you guys a little bit more about the world of trading. Some of you will be relatively new to it. Some of you will be a little bit old to it. In fact, have been more experienced traders. Hopefully everybody can learn something from what I'm saying, and I won't leave too many people behind. If you do not understand anything or any part of this, then please just put your hand up or send me something in the chat to say I don't get this, and we'll go over it again. Very happy to talk you through it. So the structure of today, we're going to talk a little bit about some the markets and sort of why they're there, and a bit about the philosophy of trading. Then we're going to discuss, really have a look at some key technical features and some setups that I like to talk about. So let's call it market structure and market price reactions. And then finally, we're going to have a look at the global macro outlook and what I've been seeing for the last few months and what possibly may be coming in the near future. As always with these things, we have to have a disclaimer. This is educational only, and if there's any trades in here that I suggest, then obviously it's up to you. If you do anything about that, I can't help you with that, and I'm not responsible for anything that happens post my recommendations. Cool. So let's kick off. Look, I think for me, the last 20 years have seen such a tremendous advantage being granted to small traders. But the question, I guess it's a bit of an open question, really. And it's like, well, have the small traders really improved? If you look back about 20 years ago, charts weren't quite being drawn by hand, but it certainly feels like it now with all the technology that's available to us. So I did have systems, and I had back testing ability with some trading systems as if you like a private trader or a small institutional trader. And so I felt that I had quite a lot of information at my fingertips. I didn't feel that was actually there for everybody, and you really had to go and find it. I got my information from a book. Nowadays, you get your information from shows like this, and from also from I guess articles on the on Bloomberg, or on the Bloomberg News, or on Reuters News, or on FX News, or any of the other news services, plus also some trading information off the internet. It is everywhere. I think if you just Google trading, financial trading information, you'll probably be swamped by millions of hits. It'll literally be millions, plus a whole bunch of adverts as well too. So the key thing is, are the small traders really getting any better? Well, I would contend that actually, to a certain extent, yes, but to a large extent, no. And I think there's something missing, and hopefully we can try and have a look at a little bit of that today. But I think part of it is people's expectations. And to succeed at anything in life, if you want to become a doctor, 7-10 years worth of training, it's quite unreasonable to think that after a month you could become a great foreign exchange trader. This is about setting out on a journey, being committed to that journey, and also spending the time and the energy to try and build up your experience and your know-how. Hopefully, you're profitable, relatively profitable from the get-go, or you're certainly not losing money from the get-go. Then really that helps the process enormously. And I think that Paul's organization is just brilliant at the way in which they, the guys at Actions to Wealth just help you along that process. It's amazing to me how effective they are and how effective they've been. So, well, okay. Sorry, folks. I'm just having a little technical issue here. Just hold on 2 seconds, and I'll be there momentarily. I'll just move a couple of things around on the screen. Okay, cool. So, I think what's really key for me is for people to figure out what they actually want to get out of trading, and let's start with today. What do you want to get out of the hour and a half with me? Hopefully you want to be a little bit better informed and perhaps inspired to go on and continue your trading journey in a much more positive fashion, hopefully with a little bit of extra information. And really, I think this is about just a little bit of ad, right? And so we're saying, okay, well, let's spend an hour and a half or 2 hours of our time with Julian. Hopefully we'll get something which will last us for many years out of that. And so really, I think you've got to have that attitude about how you view all the trading opportunities and education opportunities that you have in this area. Because if you are starting from scratch, it's a bit like learning a new language, or going to university for the first time. You're trying to absorb as much information as you can. So, one of the famous quotes that I've seen in the marketplace, and I think has been around for about 30 or 40 years now, because it came out of the original Market Wizards book by Jack Schwager, which, if you have a chance to read any of his books, I recommend any of them. They're all amazing books. But the first one, probably the Market Wizards, was, I think, possibly one of the better ones. And it's this quote by Ed Seykota, who just turned around and said, everybody gets out of the market what they want, which is another really polite way of saying sort of what you put in, you sort of get out. And the attitude you take into this is really going to determine what the outcome's going to be. So I think for me that represents the, if you like, the pinnacle of quotes about trading. So look, when I always think about the philosophy of trading, there's, at the end of the day, we're trying to make money, right? If we're not trying to make money, then it's a bit weird why you're sort of here. So on the basis that is what we're trying to achieve, and I always have at the back of my mind that there's a small percentage of people that actually aren't here to make money, which sounds a bit weird to most of you, but it is actually the truth. So, but the vast majority of us are out there trying to achieve something. So really, there's only real two ways to do it, which is, and I'm sure you've heard these expressions before in cliches, it's buy low and sell high. Well, what does that mean? That means that you're trying to trade the bottom of a trading range and sell at the top of the trading range, or maybe if it turns into a trend, sell somewhere a little bit higher than that. Or the alternative, of course, is to buy high and then sell higher. And for those of you that have been following the cryptocurrencies, I think that's probably been a bit of a watchword for the last 6 to 9 months, where some of those market moves where the markets have gone vertical in many cryptocurrencies has been a sight to behold. And something quite special, I think, in terms of the world of trading. It's certainly something I've never seen in my entire career. So it's definitely a market environment where you can buy high and sell higher. So really what you're trying to do here is trying to define whether, in some senses, whether you're a trend trader or whether you're a range trader. And then thirdly, it's the attitude that you come into this with. So if you come into this with an attitude of positive confidence that you're going to succeed, you're just a question of how you get along on the journey and how quickly it takes. I think that's the right way to do it. But equally alongside that, if you have a day job and this is your hobby and you're trying to pick something up, the concept of spending 3 hours a night in front of the screens or doing some homework is pretty heavy. Especially if you've got other commitments. So really, I think there's a balancing act to be had between the amount of energy and focus that you can put into this. And it's also really important to recognize that. So if you're just starting out and you're going to put an hour a week into it, realize that it's going to take you a little bit longer than somebody if they were going into it full time. Sort of quite necessarily, there's just an hour's committed, which just takes time. We all think we know a little bit about trading, but once you start, it seems to be a little bit more difficult than you first thought when you set out. So really for me, it's about having a reflective feel about the amount of energy and focus that you're going to give this. And that actually, in that way, I think then you're managing your own set of optimism and your own set of disappointment when, inevitably things will go wrong in trading, because they do from time to time, as to how that's going to unfold in terms of your mind. So I view this as a positive way of thinking about things. It's certainly not a negative way of thinking about things. And really, for me, it's for me right now at this stage of my trading career, it's the most crucial part of my focus. So when I talk about markets, we always talk about markets in really general terms. You got to say, well, what's the purpose of them? What are they there for? Okay, so there are two different types of players in any market in general, right? We'll ignore the government for the time being with regulation. Let's just say the market participants. So there is let's call it the commercials, which are the buyers of that produce and the sellers of that produce. And there are the people in the middle that make that happen, right? And what I mean by that is they provide the liquidity for those buyers to turn up and those sellers to turn up at different times. And they carry positions in the meantime, which enable the people who are buying or the people who are selling to get what they want done when they want it done. So in other words, they provide the liquidity. Now those, let's call it those middlemen, if you like, or liquidity providers, take two or three forms, but by and large, they're either large speculators or small speculators like us. Okay, so what we're doing when we're speculating in a market is we're probably buying it from somebody. So in other words, they're selling it to us. I wonder who they are. And then we're hoping if the market goes our way to sell it at a profit at some point in time. And who's going to be buying it from us? So these are really key questions, right? Because at the end of the day, the markets aren't set up for the people who are providing liquidity. The markets are set up for the people that need it, right? Which are the people that are producing the good and the people that are buying the good. So if you think about it in really simple terms, let's look at the corn market or the coffee. Let's make it easy. Let's look at coffee, shall we? So on one side, you have the coffee producers who are producing the beans. They use the forward market or the futures market to enable them to be able to sell their produce a little bit further ahead at a better price than they think they'll get today, or if they were able to store it at some point in the future. It gives them a bit of certainty. And at the other side, you've got Starbucks, right? And they have to buy quite a lot of coffee. And these days, of course, petrol companies as well, too, because most petrol stations are, in fact, quite large coffee houses of their own. But let's think about the Starbucks. And, every year they have a demand for a certain amount of cups of coffee, and they're trying to grow their business. And so they need to buy a little bit extra each year. And their role then is to say, well, we need to have that supply guaranteed. So they want to go into the market and be able to purchase the coffee on a regular basis and have that liquidity there. So really, when you think about the coffee market, it serves those producers and those consumers of the product, right? Now, in the middle, there's you and me, and there's a whole bunch of other funds as well, too, that are trying to make some money out of it. So guess which direction the price is going to go. And as a result of that, that those people provide the liquidity, right, with their guesses. They may have a technical pattern, they may have a fundamental reason that gives them the opportunity to either buy or sell coffee at that moment in time, because they think the price is either going to go up or sometimes go down. These days, less going down. But the key thing is that those speculators really aren't seen as being anything other than people that provide liquidity. It's there for the producers and the consumers. So why is that important? It's important because when you hear Ash talking about the commitment of traders, and also talking about the way in which the seasonal patterns work, then what Ash is really doing is saying, well, look, at certain points of the year, at certain times of the year, people demand this product, or people want to sell this product. And as a result of that, the market tends to drift in those particular directions, either up slowly or down slowly. So it's a bit of like developing an edge here, which is what I'm talking about all the time, is to say, well, look, if I know I've got a bias for the market to rise, because at this particular moment in time, I know all the consumer products, the Starbucks, if you like, are in the coffee market trying to pre-purchase the next harvest, then on that basis alone, coffee should probably drift up. And as a result of that, if I see a buy signal, a technical buy signal, I've probably got a reasonably good chance, so better than 50-50, that I'm going to be right with that purchase. And it's very important, because that edge, if you like, that we have from that seasonality, or from knowing what those commercial positions are on the commitment of traders, gives us the ability to be able just to add 4 or 5% to our trading success, which can be an extraordinary amount in terms of the P&L consequences of that. And we may get a chance to have a look at that later on in the conversation that we're having. So we need to be really clear why markets are there. So when we talk about this, is for markets are not set up for you or I, we are merely users of it. So look, when we get back to the trading now, you sort of, let's really bring this down to very simple, basic facts. Okay, when the price is going up, we pretty much want to be long. Okay, there will be a time when the price has risen to a point at which we think it's a little bit crazy, that the price might top out and might reverse, and we might want to look at that particular trade. But most of the time, when the price is rising, we would prefer to be long. And similarly, when the market is going down, we prefer to be short. Otherwise, why are we bothering? Okay, so there's not really much point being in the market. So the key thing here is, I know this sounds a bit of a truism, but we need to identify those markets which are sort of going up, and we need to identify those markets which are going down. Why? Well, that makes our job quite a bit easier, because then we know which side of the trading fence, if you like, we'd like to be on. So if the market is going up, clearly we just want to take longs, and we'll avoid taking short positions. And we may get a short signal from some of our systems, but we'll be more inclined to either ignore that or put that on in smaller risk, because the general drift of the market is to the upside. And similarly for the downside. And look, guys, when markets aren't trending, which they only normally trend about 30 to 40% of the time, we've just come off a significant number of trends in quite a few commodity markets. I think we're certainly taking a little bit of a pause at the moment, especially in crypto as well too. There is, you could probably quite rightly say that if you were just a long player in some of these markets, that you'd be quiet and you'd be out of it right now. If you were a short player, you might want to be a little bit more aggressive and think about, retest of the highs as opportunities to sell and things like that. So the key thing is that we need to be conscious that when nothing is happening, that we're sitting on the sidelines saving our capital, because it does two things. That's the physical capital, i.e. the money in our account, but equally it's also the mental capital as well too. So we're not trying to fight the market or try and find a trend when there isn't one. We're actually able to go and do something else with our lives while we're waiting for the markets to move again, and then we get interested. Quite an important point, and I think something that I really would like to remind people to, just in very simple terms, always have at the back of their mind. So there are other ways to trade. Okay, so some people feel very uncomfortable trading significant trends, and as I said, the market trends about 30% of the time. So you could sort of go, well, by definition, 2/3 of the time it doesn't trend. Well, that's interesting. Therefore, wouldn't it be better if I was somebody who traded that environment, where I was looking for intermediate term highs and intermediate term lows, and I would assume that they're going to be revisited in a ping pong fashion, if you like. Let's call that range trading. So there are people who specialize in range trading and absolutely hate trends, and they have particular tools and strategies involved around that. There are also people that like to trade options as well too. Now, options aren't available in every market. They're becoming increasingly more available and more liquid as the years go by, and especially in America, there on most of the financial markets there's a significant option, if you like, industry that's been built up around most of the commodities and financial contracts and stocks that are out there. But that's not the case in every part of the world, and certainly it's not necessarily accessible to people like you and me, the relatively smaller traders. But there are people that specialize in just option trading, where they trade different parts of options, so different parts of the pricing, which is volatility and time decay, and also option spreads as well too. That's a discussion for the time. I won't get into that. At one point in time, I will do some kind of options course, I think, but not today. But the key point here really is that it depends on the individual trader. This is where life can get a bit confusing. Oh my God, all these different products, and what do I do and how do I think about it? Well, the short answer is you start with the easiest ones, and the easiest ones, when the market's going up, you want to be long. When the market's going down, you want to be short. Let's work on that, and let's move forward. So, okay, when you're thinking about trader success, so when you're trying to plot how you are going to develop as a trader, now some people like to do this a little bit quantitatively. I'm more qualitative about this, a bit of a look back every 6 months or so. There's two real things that you're looking to develop, right? The first one is your statistical edge. So that's saying that I have a probability of success of 60% for these trades, and let's say a reward to risk of 2 to 1. Okay, so on that basis alone, I could do a spreadsheet and I could sit down, I could prove to you that you're going to make money. So that's your statistical edge. Now, how do you get that? Well, you get that by having some trading systems which optimize your entries and your exits as well too. And as a result of that, you develop a ability which is slightly better than a coin toss. Brilliant. Which is really good. However, that's not the whole part of the picture. That's only just one part. The second thing is developing your mental edge. Now, why is that important? Well, as you're busy developing your statistical edge, you will find that 60% success means that 40% of the time you won't be successful. Well, I wonder what those unsuccessful trades look like, and you will find there will be times when you will be unsuccessful for trade after trade after trade. Depending on the type of model that you're using, it's not unusual to have 3 or 4, sometimes even 5 losers in a row. So if that is the case, then what's that doing to our mental edge and our energy and focus, that thing I talked about at the very beginning? Well, really what's important here is to be able to maintain your stability, right? To be able to maintain not just a positive mental attitude or one of those cliches out there, but really saying that my mental edge here that I have is that I understand the way that my system works and my methods work, and I understand how they can go right, and I understand when they can go wrong, and I understand those market states. And as a result of those things, I feel that I'm able to have more resilience around when things go wrong. When things are going right, it's very hard to not enjoy your time as a trader. The real challenge comes when things are going wrong. So that's when people leave the business, or they change methodologies, or they panic, or they start to lose sleep at night, and all those horrible things that you can go through, affecting both your mental and your physical capital. A lot of the time when you sit down and talk to people about that aspect of their trading, it's interesting what turns out, because what actually turns out is they haven't done the research. So the research on their methodology. So if you knew, for instance, that the methodology that you trade has an average of 3 losers in a row and can go to 5 losers max, there's never been a time when there's been 6 losers in a row, then actually that's quite a powerful piece of information. So why is that? Well, number one, it's not quite as painful as you thought it was going to be, because the bad stuff stops at some point in time. Secondly, this is an advantage for you because you can say, well, look, if on average it's 3 losers in a row with a max of 5, then actually when I get to 3, I can start to get quite excited. Not because of some kind of conditional probability, but actually just the statistics to say that probably from here, things are going to get a little bit better. Okay, and that's quite important. So this is about managing your expectations. So again, we come back to this thing again where we're talking about managing our progress as a trader, not just from a spreadsheet, but actually from the way in which we're developing that resilience we need in order to get better. Because every glass ceiling that we punch through, right, as we grow the account, as we expand our activities, as we get more experience, every one of those glass ceilings we break is quite hard work. And it's not straightforward, and it requires a lot of faith and sometimes just a little bit of hope and luck as well too. So what's really important here is to have that mental awareness that those things are what's going to unfold. You're going to have good days, you're going to have bad days, but on the whole, life should be better than what it was before. So providing you keep that in mind, I think that's a great start and a way to think about trading in a way that not everybody tends to explain it. We often tend to focus on the quantitative stuff without necessarily focusing on how we're feeling about all of this. So for me, that mental edge really is the keys to the kingdom. And we yet again come to that cliched phrase, but if it isn't a cliche, let's say it anyway, right? About energy and focus. So this is about getting enough rest, about making sure that you're able to concentrate when the time comes. You know, not just because it's new and it's shiny, but because we're going to put some energy and some effort into this, and we recognize that. And building, if you want to, do this on a slightly more detailed basis, building a plan for managing how you're going to get better. So a commitment of hours every week, a commitment of hours every month or days every month of what you'd like, and hopefully what you'd like to try and achieve at the end of it. And as always with these things, as human beings, we're awful about thinking that things are changing over the course of a short period of time. Because we often don't see the improvement. But if we tend to look back after 6 months and say, oh my God, can you imagine what I was like then? And look how much I've learnt in the meantime, it's usually quite remarkable things start to take place, which sometimes is a really good reason for you to have, say, a trading plan, but a trading education plan. So have a think about what you're trying to achieve over the next few weeks, few months, and how you can get your coaches to help you achieve that, in terms of, not necessarily in terms of results, because trust me, results will take care of themselves. What you've got to do is to make sure that you're doing everything right. So do I have a routine every day where I look at the markets? Do I have a way to put my orders in that make me comfortable, that I can switch the PC off and it'll still be okay, and those orders when they get triggered will still work fine? What about the exits if I have a position on? And do I need to make sure that I'm switching the screen off to stop myself and taking my profits too early, or taking them too late by not ever looking at the screen? Okay, so some of those things, some of those challenges, you need to try and identify which one of those are helping or hindering you as you go through the process of learning to be a better trader, and trying to make sure that you spend the right amount of time trying to think about and educate yourself about each one of those. So look, the key thing about this is, you say, well, look, do I not have to have a particular talent to be a trader? Well, here we go. This is absolutely something that requires zero talent whatsoever. Thank God. Because some of these are quite important to me, and if it required talent, I may be in trouble. So look, turning up on time, having a worth education, effort, energy, body language, attitude, being coachable, being prepared, doing some extra, passion, none of those require any special talent. What it does is require that, I guess you could have that mental edge of motivation. So you can achieve a lot and be a very competent trader without having any, what they might call in air quotes, talent for the role. What I prefer to call experience and the ability to manage your risk a little bit better. So the question is, now you're asking, because I can hear everybody going, well, that's all very well, Julian, but how? Okay, so let's think about how we can improve. So what I want to try and do is I just want to take you through my 4-box methodology, which sort of actually goes in a bit of a circle, which is odd, but we'll avoid the geometric paradox here, and we'll just try and talk our way through what I see as being the way to improve as a trader. Now, everybody starts at ground zero. You might be ground zero, you might be ground floor 15, and trying to think about how you're going to improve from being a competent trader already. What's the next steps? You have a certain amount of potential. It is sitting there waiting to be used. So how are you going to use that potential? Well, believe it or not, you have to do something called taking some action. Now, that means that you've got to get up or sit down in some cases and write some stuff down and try and educate yourself about what you need to do next. I'm not talking about taking a trade here. What I'm talking about is about learning how to be a better trader. So you need to take some action towards that. And often we find when you take some action and put some effort in, there will be a set of results which will be different to what you've had before. Otherwise, you have no definition of sociopathic behavior. So what we have here is the opportunity for us, when we've done something and we are doing something that is different to what we've done before, that there will be a different outcome. In this case, a more positive outcome. And those results change your belief as a trader. And you say, well, look, now I'm getting a different set of results to the ones I got before, and we'll work on the assumption that they're better results, right? Now we're getting those different set of results. That now means that I am improving as a trader. So my confidence level has gone from 1 to, let's call it 2. Well, interestingly, as your belief that you are getting a better trader comes into your thinking, quite obviously what happens next is you then start to see the potential for what this can do in the future, because this has been a circle of success. And so as a result of that, you continue to take additional action to improve your learning and improve your strategies and improve your risk management. And the results will get better. Can't guarantee they're going to get better on day one, but they will get better when we look at over those 3 to 6 month time frame. I see that Jessica, you've raised a hand. If you wanted to put something on the chat, then by all means, please do if you have a question. As a result of that, we then hit our virtuous circle, which then means that we are getting better as a trader. Now, again, you say, Julian, well, this is all very interesting. So, but I'm not quite sure what these things mean. Now, hold on a second. I will then say to you, the education program that Paul and the guys put together for you in terms of the educational program, the access to the coaches, the trading systems that you have, the account that you can trade, everything is there for you to be successful. All you've got to do is to do something about it. So my advice to you is to think about this circle of action, and as a result of that, start to do something, and then things will start to change, right? This is how life works, right? Now, you may see this in other walks of life a little bit quicker or a little bit slower. You know, think of taking up a new sport to be a very good example, right? I often feel traders are very close to sportsmen in the way that their attitude and their approach to their chosen profession is. So really with this, it's about believing in a virtuous circle, because it's very easy when you're working as a trader, which can be a very lonely occupation, to get yourself in the opposite cycle if things aren't going quite as well as you either thought or had planned. That you can get yourself into a vicious cycle. I haven't put that on the screen. I don't want to put that on the screen because we're talking about positive things here. And I think really what you've got to do is to recognize that whatever you are, whatever stage you are in trading, there's always more things that you can learn. This is one of those professions, I'm afraid, where you will be learning for the rest of your life about how to manage your risk and do things slightly better. You might have the same systems in 20 years' time, but believe me, you will be thinking about risk management in a completely different way. So really, how I like to feel about this, and how in my mind I'm trying to do this, is I have a 4 stages, right? Which is the unconscious incompetence. So that's the beginners, let's call it that. The conscious incompetence, the improvers, right? The conscious competence, we're starting to get the hang of this now. And then finally the unconscious competence, which then means at this point we can consider ourselves to be a reasonably good trader, and we just do things because they show up and we know exactly what to do and we execute it well. So to get to that point, that skilled stage, is not something you can achieve over the course of a month. It takes time. When you recognize it takes time, then that also helps that process. So when you hear those expressions out there saying, oh, somebody has that trader instinct, what does that mean? Trust me, what it means is that they've been there before, they've done it, they understand it. You know, people who work in the rag trade, sorry, the not English expression, in the fashion industry, right? Understand trading intuitively. Why do they do that? Because you walk into a store, you know, we've all done this. You walk into a store, the new fashion's there, and you pay the largest price that you're going to pay for that piece of clothing when it first comes out, right? Why? Because it's not to say because it's new and shiny. It's because actually you like it and it's on point, it's on trend. Your friends will like it too, and so therefore it's a sort of piece of clothing to have. Now, as you get towards the end of the season, you've worn it a few times. Not that it's threadbare, but you've worn it a few times, and it's also going to be replaced by something new that's coming out in a few weeks' time. And so what the retailer does is that anything he hasn't sold when it comes towards the end of the season, right, he has to discount and get out the door as fast as possible, right? He intuitively understands risk management, right? I've got to get something for this. I'll sell it at whatever price I need to clear it off the shelves, right? Anything, give me anything for it. I might have paid anything, preferably above cost. Sometimes they just sell it to get it out the door. And then they're moving on to the next piece of clothing, right? The next new trend, okay? And so that's really, if you think about it, a lot of what trading is all about, and that's where that so-called trading instinct come from. But trading instinct also is based on a set of rules and principles. So it's a new fashion. I'm going to try and charge as much as I can up front and make all the profit I can right now, because I know that in 3 months' time, when it isn't popular anymore, because people will have moved on to a different season or a different fashion, a different piece of fashion, clothing, item, or person, that I need to get rid of this then at the maximum profitable point for me, which is like day one, right? So these are some of the rules. As you know, if you want to struggle in the fashion industry or in the clothing industry, what you do is hold on to clothes too long, right? That's a great way to struggle. So this is the sort of thing that you have with trading. If you want to hold on to a losing position for too long, then you're going to struggle. You're going to eat up too much of your capital. You want to get rid of losing positions as fast as possible and try, if you can, and hold on to those winners for as long as you possibly can, and ride that new trend if it's a trend, or ride the range trade if it's a range trade, or ride the options if it's an options, for as long as you possibly can to maximize the profitability. So that's for me, there's no real difference between those two. What is the difference is just experience. And also, when you start out in trading, I find that, sorry, actually, just excuse me for 1 second. I just need to take a quick liquid refreshment break. No. So I have very small teacups in my house. So when you start out in trading, I think one of the things you love to do is to trade lots. Okay, I want to get going in this. Yes, what I've got to do is to put my wrist to work that I've got. I'm going to put some trades on, and hopefully there'll be winners, right? So bit of a hope. The great thing about sometimes with trading is actually not doing anything. Is to say, nope, this doesn't suit me right now. I'm not getting what I want. The world is range trading. I'm a trend trader. So all I'm going to do is I'll wait until I see a trend start to emerge, and then I'll trade that, rather than trying to trade a range, which is something I don't really know how to do. So there's actually nothing wrong with doing nothing. However, you're still learning. What are you learning? You're learning when to put trades on and when to react, rather than when not to react, if you like, if that makes sense to you. And when you are reacting, you have a reason for doing it. The other side of it is when things are going well, you've got to keep pushing. You know, this is not the time to head off to the golf club to play 18 holes of golf if things are going well. So keep pushing as hard as you can and try and make sure that you're taking as much out of the market, because it doesn't give you very much time to do that until it then decides that that it's had enough of your trading methodology or the way that you're thinking or your market state, and it wants to change again. So the key point here is to actually do to keep doing things when you're going well, keep trading when you're trading well, and try and stop trading when you're not, or the market doesn't suit. And the final point here is to manage risk effectively by essentially healing as quickly as you can. So when things go awry, you have to put it behind you very quickly. If you are going to dwell on every loss that you took, every loss that you take, I'm afraid trading is going to be a very mentally anguished time for you. And just to reiterate this, right, rest and energy are absolutely vital. There is a bit here about, making sure that you're methodical about taking your time to do things, and you'll get better at it. Trust me, you'll get better and faster as time goes on, and more comfortable with your approaches as time goes on. You'll actually see them before the systems will show them up. So there's no problem in taking your time and getting this right. When I talk to people about trading, I always have this sort of story when I said, look, I could give 3 people the same trading system with exactly the same parameters, and they'd all come out with different results. And a lot of this has got to do with their approach to the market, not my system's approach, right? My system will be my system. It will trade the same way every single time. But what gives different results out is the way that people manage their risk and the way in which they act diligently to either put every single trade on or put only as ones on that they feel are appropriate. Right? So often you will get differences. In fact, almost all the time you get differences. So every trader is different. You're different. I'm different. We're all different. Anybody who's listening in today, okay? Just trust me, we all have a slightly different way of managing our trading. What you need to do is to understand what suits you. Okay, over the years, I've figured out in broad terms what makes me work well as a trader, and more importantly, what makes me not work well as a trader. And I encourage you to think very carefully about your trading style. You can be a risk seeker and be a great trader, and you can be a risk averse trader and be very much a great trader. So it doesn't require a particular risk profile. It doesn't require any particular set of skills that are held by a few people. It just requires consistency. So when I think about what I do, I would classify myself as a conditional trader. Okay, and what do I mean by that? I mean that when I take a trade, I actually don't want to just take it because I see some price action on the chart. What do I mean by that? Well, I like to look at some of what you might consider to be fundamental, but I don't, just sort of, let's call it general market supply demand dynamics in the background. So things like seasonal patterns, these repeat every single year, all the time. And commercial positions are also important as well too. So what are the major players in the market doing? Are they buying? Are they selling? Are they substantially long? Are they substantially short? Really important for me. What are the long and the medium term cycles that are going on out there? What do I mean by that? Well, for instance, the British pound has between a 6 and 8 year cycle that seems to repeat itself and has done for the last 50 years. One could make the assumption that probably for the next 30 or 40 years that cycle will continue to repeat itself. So how do we use that information? Well, at the moment we're in an upswing on the British pound, and as you can see from the charts over the course of the last 3 to 4 months, the British pound has been doing relatively well. Now, my contention is it's been doing relatively well for for quite a considerable period of time since the Brexit result was announced, and I believe we have about another 12 months to go on that. About the end of 21, midway 22, that cycle might look to start turning again, but for the time being we're still in a bull market environment for the British pound. So therefore, when I look at medium-term trades in British pounds, I think about, well, do I want to be short British pounds or long British pounds? Well, I prefer to be long, so if the opportunity comes, then I will simply position myself long at British pounds and put more at risk on those trades than I would on a short trade during this particular upswing cycle in the British pound. So that's how I use that. Also, sentiment for me is really important. So Gosh, and even more so at the moment with so many extreme market moves. I'll show you some charts of a couple of commodities later on, but anybody who's been trading cryptocurrencies, unless you've been hiding in a cave for the last 2 weeks, is aware that the crypto market has had a bit of an accident and it's lost a considerable amount of value. I can't speak for the altcoins, but Ethereum and Bitcoin have, I think, lost between 30 and 50% of their value in the course of a week. Well, that's quite a significant amount of money if you're unfortunate enough to buy anywhere near the highs. But more importantly, if you weren't and you'd made a lot of money and then have given it all back again, you still are not particularly happy. And as a result of that, what I try and do all the time, because of these market swings, is think about where people are positioned and what they're thinking. So I suspect that Bitcoin didn't necessarily go down because there were just lots of sellers showed up. I think it went down because there weren't many other people left to buy it. Everybody who wanted to buy crypto had actually bought it. So therefore, the market just drifted down. And then that began to accelerate as people started to lose money. So sentiment for me is incredibly important. It often marks significant highs and significant lows in the market. One of the challenges we have is that it's really hard to define. So how do we say the market is in throw up mode and just hates everybody? And there's lots of people say, well, I never want to trade that one again. That's an interesting sentiment point. For me, I get quite excited then. So for equally, the other side of the coin is when you have everybody speaking about how much money they're making or their friends are making in certain asset classes. So think crypto is an obvious example, but also think about oil, think about copper, think about steel, corn, wheat, sugar, coffee. God, the list goes on at the moment. They're endless examples in the commodity market and also in the stock market as well too. There's a lot of people who had shares in Tesla all the way from $100 to $900. Did they sell at $900 when they were sitting on an extraordinary profit in a company that was worth $1 trillion but yet still manages to not make much money? Well, no, they didn't. A lot of people didn't, and here we are now at $500 and something, and maybe they're not selling now. I often wonder where they will sell, because that company is has a track record of spending money, not a huge track record of making money. And so really, when you're talking about this sentiment, it's really about deciding where everybody has significant positions, one side or the other. I often call it going to one side. Everybody's on one side of the boat. It's a surprise that the boat hasn't capsized. So I prefer to run to the other side first. In other words, I'm not trying to pick the top of the market, but I'd like to be aware that there's an opportunity here for me to make money if that market reverses. Now, why am I interested in that? Well, I'm interested in that because the reward to risk of those snapback trades is often 5 or 6 to 1 for a very high reward to risk if you get the timing right. Sure, you're going to lose some of them, but on some of them, but not necessarily on all of them. So really what I tend to do is when the market is set up in my favor, then I'll start to enter some trades and enter trades relatively aggressively. For those of you who are on my broadcast group, you'll know at the moment that I'm not particularly bullish on the US dollar. I have 2 trades on at the moment where I'm short of the Aussie dollar, amongst others. And the reason for this is because I am at the moment a belief that I think there's a deflation problem, and we'll talk about that a little bit later on. And the market's got a bit ahead of itself just about everywhere, and it's due for a bit of a comeback, and that could be quite US dollar positive. Not everywhere and in every single currency, but in some of them, I think there could be some setbacks. So I have a couple of trades on as a trial to see if we can really start to get those risk reversals in place, and that could be very good for us. So all the time I'm thinking about not just the lines on the chart. I want some supporting arguments, and that for me is really important. So when I think about trading, okay, there are 3 major elements of a trading strategy for me. The first one is selecting the right market. So what's hot? If I'm a range trader, what's range trading? That would be things that are coming to the end of a trend, and things that have reach the bottom or the top of a recent move, right? So I'm getting quite interested then, and also markets which are really moribund and there's no real outlook change on the horizon from any of the economists seeing anything changing there. Okay, but if I'm a trend trader, then what I want is the beginning of a trend, middle of a trend, end of a trend, to take advantage of that major movement to maximize my profit as quickly as I can, to be able to be in the market for as little time as I can and really exploit that trend for as long as I can. Having identified those markets that suit my trading style, if you like, they're on my watch list, I then move into the timing phase. Now, what do I mean by that? I mean, well, what I'm trying to do then is to make sure that I use my systems and my techniques to give me an entry point where I can define my risk. And this is the key thing, right? The reason why we bother with this, right? The reason why we have spend any time at all on market timing is actually about managing risk. I'm not really interested in taking trades on where I've got a one-to-one risk reward, right? That's interesting, but I'm not really going to make a lot of money in the medium term, and the volatility of my returns is not going to be very good. What I'm really trying to do is to get those 2-to-1, 3-to-1 trades out. And how do I do that? Well, I have a way of, I need to predefine where I'm going to exit if I'm wrong. And that's where timing comes in. What you're trying to do is to take a position in the market where you know exactly where your exit point is predefined if it goes wrong. And that's the key thing about timing. And that then feeds into what I consider to be the keys of the kingdom, which is management. Now, this is broken up into two sections, but I have it in capitals here. But it's broken up into two sections, which firstly is managing your trade. So that what I was talking about earlier, that risk reward trade. So managing your exit if it goes wrong, also managing your profit if it goes right. So how do I do that? How do I use trailing? Pardon me. How do I use trailing stops? How do I think about exit points or target points for me to get out of trades? But it also means, how am I going to manage my account balance? So now I can start to talk about things like the average of the last, having a trailing average of the last 30 trades in terms of the amount of money I've made, whereby if it breaks that moving average, I might well stop trading that particular methodology until it comes above the average line again. Maybe I'll show you an example of that later on. But for me, it's about managing the account. Now, that's about the amount of size that I'm putting on any particular trade. And I know that with Paul's account, you have a set size that you're allowed to use. But they might want to vary that if you're trading that privately. And also what impact that has on my account balance in the way in which it determines the results from the timing methodology that I'm using here to get into that particular market. So when I think about trading, risk management for me is my number one thought bubble, right? So try and avoid too many losses, right? The profits will take care of themselves. All the other stuff is about putting you in a position to really make sure that you're maximizing those opportunities. But really, the risk management for me is the key aspect to the trading decision. So just to reiterate the point, right? Technical analysis sometimes can confuse people. There's an awful lot going on when you listen to people who are talking. You listen to some of the analysts who talk about technical setups in the market. I prefer to do my own, and I prefer to have relatively simple things. I really rely on the bar or the candlestick charts as a first off. I don't tend to rely on this cocktail of confusion that sometimes you can have. So, guys, what I'd like to do here, if you like, is just take a quick 5-minute break, or it might have been making a 7-minute break, and let's come back here in 7 minutes' time, at 15 minutes past the hour. So we just take a few minutes, and I'll see you in a short while. Thank you. Hey folks, thank you for coming back to me. Let's just continue with our with the masterclass now. Hopefully everybody's got what I've been saying so far. If you haven't, can you please ask me a question on the chat box? I am diligently waiting for somebody to ask me some questions down here. I can see there's quite a few of you in the room today, and I hope I'm making myself clear. But if not, please ask me anything you like as we go along. I suspect I'm going to get asked quite a few more questions towards the end of the talk when I talk about the current macro environment and what how that's affecting our trading, rather than necessarily where we are at the moment. But as always, please, it's an important part of the interactive nature of this that we talk as much as we can. So please do so if you have the opportunity. Okay, right. So let's keep going. Okay. When we talk about markets, I'm going to talk for a brief moment about something called market structure. And what do I mean by market structure? Well, market structure is how we interpret charts based on the action that we get for that particular trading period. And that trading period may be a day, it may be a week, it may be a month. It might even be 5 minutes as well too if you're trading relatively short term. The point is that there is a structure to the market that we can define by a candlestick or a basic bar chart. This way, from our perspective, it's a very good way of organizing what's taken place over this particular trading period. So the basic bar chart on the left is, as you can see, we'll call that a negative bar. And why is it a negative bar chart? Well, because the close is below the opening price. But there's more to it than that. Right? So you can see, oh yeah, that open to close is negative, but hang on a second. When I look at this, isn't the open in the top 25% of the range of the day? And isn't the close in the bottom 15% of the range of the day? So if you think about what's happened here, okay, the market has opened, it's gone up a touch, and then sellers have come into the market, or there hasn't been, some of the buyers have withdrawn, and the price has gone down, and we've closed somewhere near the low of the day. Well, that's actually quite a lot of information there, isn't it? Isn't that a trend of a kind? Obviously, it's represented by in this case, a blue shaded bar, but there may be different types of shadings. You may have a red. I don't think many people do blue or green for down bars, but just in case you do, then that's also fine as well too. But it's clearly with the bar, the candlestick chart will be colored in for the negative outcome. But again, the same principle applies, right? You know, we have the opening price, we have the closing price, and they're telling us a message, right? The message is that it's a sell day. Okay, the extent of that sell day is really going to be referenced against the other bars that are around it. So we may have big bars, we may have small bars, we may have bars that are parallel to this, we may have bars that are above or below this. Right? All of those things are the next level, if you like, or the first derivative of this. But really what's important at this point is to understand the basic pattern and what that means. So why is this important? Okay, well, it's important because when the markets trend, they tend to trend in one direction or another quite often for a considerable period of time. So if you look at the Euro-Swiss relocated from the 108 to 107 range in back in January and February to a new range of between 110 and 111, vaguely, right? The journey to get there, to relocate to that new trading range, really took place over the course of 10 to 15 days. Now, let's look at these bars. Now, in this instance, blue means positive bar, so the close is above the open, and red means a negative bar, so the close is below the open. So what we have here in terms of when this trend began, if you look at this day one, let's call this day one down here, right? This little ring low formation that we've got set up here. Okay, we have the open is below the close. The open is below the close. The open is below the close. Well, hang on a second. So what you're telling me is that for 3 straight days, the market has gone in one direction. Yes, that's exactly what I'm saying. So that's not unusual. We go back and look earlier on in the chart towards the end of January, the market did exactly the same. It had 3 days where it closed in a positive way. So that's interesting, because when we have 3, that doesn't necessarily mean there's a new trend. But can you see 4 on this chart? Maybe we could go back. I can't go back a little further. Sorry, guys. I apologize. I can't go back a little further because it's a slide. It's not a chart. So what we'll do is, if you want to go back and have a look a little further, maybe you can see something different in the previous chart for January for this Euro Swiss. But what we have here is we have 3 in a row, then a red bar, then a blue bar, then a red bar, then a blue bar, then another blue bar. So there's 2 in a row. Then we have 2 red bars. Then we have 2 blue. Nothing is happening. All right, it's random at the moment, or relatively random, right? And then we have 3 in a row. Well, that's interesting, and we're now trading near the top of the trading range, and then we blast out the top of the trading range with 4 in a row. Well, at this point, all the breakout guys are getting interested. So why are they getting interested? Well, because your risk is from here to here, which is roughly 60 pips, and your reward hopefully will be something better than that. And what was that reward? Well, if we look at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days later, the reward was 3 big figures, right? So 60 cents loss against 300 gain. Okay, that's a pretty good, by my estimation, pretty good guess, about 3 or 4 to 1 ratio for your reward to risk. So all of a sudden our interest is peaked. So how do we think about this? Well, what's happened here is we have a set of positive bars that we've got to be on alert for. So here's a mini trading system. Okay, look. Close above the open, close above the open, close above the open. So funnily enough, when things go upwards, they don't tend to go upwards in anything other than a straight line. And when they do that, it's logical to think that the close will be above the opening price. Otherwise, it would be very weird. The market would have to gap much higher, screw around a bit, and then still close positively to keep going up. Doesn't happen very often. What tends to happen normally is you have this growing trading range with growing volatility, which is a sign that more people are getting involved. So here you have 1, 2, 3, 4, 5, 6 bars. Is that 6? I've got 7. 7 bars up where the close is higher than the open. And then on this 8th day, you have a negative bar. Gosh, the close is lower than the open, but lower than the open by 10 pips. The next day is our first real day of loss, where we lose something in the order of 40 or 50 pips worth of loss if we'd have bought it on the opening price and then got out on the close. The next day, don't worry, we got it all back again, as we did the day after that, the day after that, and the day after that. So with really one significant down day out of, what is this, 9, 10, 11, 12, 13, 14 or 15 days, right? One significant down day. You've had one real losing day out of 15, right? So all of a sudden, you can see in my mind, I can see everybody whirring this over going, well, isn't that a trading system, Julian? And the answer to that will be, well, it could be. One of the most easiest trading systems that you can have in the market is to simply buy on the close with a stop loss. Now, why do you want to do that? Well, because if the market is trending up, it's simply the most effective way to take a position in the marketplace that there is, right? Boom, that's it, right? If it's going up, you want to be long. And how do you get long? Well, you buy it on the close if it's still going up, or you buy it on the open if it's still going up. You know, you decide, right? But the point is, when you have this one directional ability out of 15 days, that only one out of 15 days, so let's call it 1.5, right? So 13.5 days were winners. Then all of a sudden you have a crazy successful trading system. Now, it doesn't take a genius to figure out that actually what you need with this is to be some idea that there's a trend, because otherwise this life is going to be more difficult in this environment. So I will leave you to figure out what determines a trend. But these examples are all over the place. I think what's really important here is to get a feel for how markets relocate to different price levels and the way they do it. There is a tendency these days at the moment, as I speak at the moment, for some of the markets to chop around but still trend in a directional fashion, but have lots of positive and then negative days, and the cycle's pretty rough. Overall, you end up somewhere, but it can be a bit tricky. That is a sign that the market is trying to find itself. It's not a sign of a strong trend. This is the true definition of a strong trend. For those of you at Elliott Wavers, you have wave 1, wave 2, wave 3, wave 4, wave 5. And if you unpick it by going to 240-minute charts or something like that, you'll see those more clearly. Okay, so what we need to do is to try and make sure, if we're trend traders, to be on that trend. So let's go and look at a different example. Okay, this is Euro Sterling. Now, Euro Sterling, we're going the other direction. We are consolidating for a period of time, right? This is a 240-minute bar chart. Then we start to break down. Look at what's happening here. What's going on? Well, the close is below the open. Here, the close is below the open in some spectacular way, right? Close below the open. Oh, hang on, no, small loss because the open is above the close. And then we get back on track again. Then we have nothing at all. Then we're back on track again. Whoops. I keep doing this. And then we have a small loss again. Then we're still selling, and a small loss again. We're still selling. And then we have a big profit. And then we sort of bring this, I guess you could argue, via a ring low formation, we bring the trend to a short-term end. Right? So for this movement here, from here, which happened at the tail end of March, all the way through from this middle of March breakdown over 1, 2, 3, 4, 5, 6, 7, 8, 9, 11, 12, 13 days. 13 days. That's a Tom DeMark sequence for the record, but 13 days of price action. We lost a little bit of money here, a little bit of money here, a little bit of money here, a little bit of money there. All the rest were profitable days where if we simply sold the open, bought it back on the close, we would have made money. Okay, this is how markets relocate to different price levels. Getting the hang of this now, aren't you? Let's go again. This is a rather popular currency pair at the moment, or currency at the moment. This is Bitcoin. So what are we looking at here? Well, believe it or not, over the course of May, early May, the markets were consolidating at where? About the 58,000 mark. This is actually the future, by the way, so it has a lot of gaps on it. It's not the continuous market. And then it began to go down. Right, so here the open was above the close. So close below open, 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 open below close, but for a small amount. And then finally, I think this was Friday, I believe, the close was indeed below the open one more time. So you might argue, I don't quite know where Bitcoin's trading this afternoon. We've had a whole 2 days, which these days seems to be a lifetime for Bitcoin, whereby it may be going somewhere else. But during this phase that we had here, 1, 2, 3, 4, 5, 6, 7, 8 days, right? Technically 9, 10, because we sort of started with a high up here. Then we had an inside day. Out of those 10 days, let's call it, only one of them has had any meaningful loss. This one here we wouldn't even classify as. Otherwise, as the market was relocating, you were better off just selling it on the open and buying it back on the close for profit, yet to get another successful trade. So this is about defining that trend via a cycle or a seasonal or some other pattern, and then taking advantage of it when it starts to break out by making sure that you're on board. Here we have in candlestick money, the same thing applying. This is an Aussie dollar. And here we have a sequence here of 1, 2, 3, 4, 5, 6, 7, 8, 9. I guess you could argue 10 days, but probably 9 days until we set the high in place on a closing basis. 8 or 9 days. And then we sort of had a correction. And this was back in 2018. I'm afraid I don't know what happened next. It could be quite exciting, but who knows? The point is, as they relocated to a new price level, the directional price thing didn't change. Every single day was a positive day. So this is how markets relocate. Similarly, this is sterling yen as it went down. There were 1 or 2 days where you lost money. Let's call those the green boxes. The rest of the time, the red boxes far outweigh the green boxes on the journey from high to low. Okay, and then finally, one last example. This is cable, and this is again back in 2018. This lovely one-directional market where there was 1, 2, 3, if we can even call that, 4, 5 meaningful loss days in about 30. Right? It was just an extraordinary run where it went from 143 down to 133, 10 big figures, and it just kept going. Yeah, look, and thank you, Helen. And yeah, so I was just reading some of the questions actually that people have got. So got a question on Euro US dollar for later on its crazy macro extension. I'm not sure what that means. Hopefully you can answer that question from Helen. And then secondly, Helen's come in with shocking relocations without notice lately, rapid ups and downs to all-time highs or lows. Exactly. Now, the key thing is it? Is it shocking and is it without notice? I would argue that some of the commodity moves that we've seen now are the last extension of wave one of a big commodity super cycle that may be taking place out there. Okay, and we're now going to go into a consolidation phase. I will talk about that later on, but really what's important about that is, yes, markets have been going vertical, and I can show you some charts. I think they've got a couple in a minute of commodities which are completely nutty and crazy, but it's actually happening. Here we go, Helen. Literally, as you speak, we turn up the volume with a amazing chart. So if you want to count the number of blue bars on an uptrend there, this is the lumber futures on the CME. This is real time, folks. This is as we speak. Look at that high of 1750 and the low of 1200. So 550 out of 1750 by my money is somewhere about 25 or 30%. Let's call it 25%. It's a lot, and that all took place over 1, 2, 3, 4, 5, 6, 7 days, right? The market just completely went down and collapsed. However, the journey upwards during March, April, and the early part of May was nothing short of spectacular. This is lumber futures, folks. It is possibly the most boring commodity future on the planet. No, I'm absolutely convinced it's the most boring commodity future on the planet. There may be some other ones, but looking at lumps of wood doesn't excite me in any shape or form. Okay, a nice table excites me, but lumps of wood doesn't really do much for me. I don't go around saying, oh my God, I've got to have those sleepers in my garden. So the key thing here is, right, when you look at this, is the one directional nature of this market. So when you understand that, oh, let's build a breakout system from one directional trading, you could say, well, let's say, how many do we need here? 4 or 5 days. Even if you took 6 days as your measure before you started to buy, 6 days here will put you round about down here in this area, and then you still got all of this to go after you've entered the market. So extraordinary price moves. This is not, well, this is quite unusual actually, but if you look at the cryptocurrencies, certainly not unusual. And you've got to have that ability to pick the right time frame. In lumber cases, we can't really trade at anything other than daily because lumber doesn't really trade that much on, and so daily is all we can do. And where you see all these big gaps, this is often limit moves. There wouldn't have been maybe not even any trading here on the way down. This might have just been limit moves that occurred. This one here was a limit move. So what I mean by that is the market opens. And it opens the absolute maximum the CME will allow to move it from the previous day, and then the market will promptly shut again. So whatever position you have, you can't get out of it. If you're long or if you're short, you can't get out. It's one of those happy things that if you're on the wrong side of it, it's the most horrible thing in the world. If you're on the right side of it, of course, it's lovely. And I've been in both. Trust me, I think when I saw it, I think there was one market that went limit down for like 8 straight days and some crazy thing. That's not a way to risk manage any position whatsoever, which is one of the reasons why looking at commodities is interesting. Trading them is another thing altogether. So only for the faint, not for the faint-hearted, guys. So the key thing here is, right, you could argue that there's all your different waves, Elliott waves in there, and where we're going now, we have to prove this case, and maybe we're going back up here to the 1600s or something before we maybe set down, or maybe we go to new highs, I don't know. But certainly with this type of volatility, it would suggest that we've reached some kind of intermediate high, and we're now going to play out some kind of retracement game, probably back down to the $1,000 mark or something like that. Who knows? I'm just making this up, but it seems to be interesting. So Helen's just asked, do you hold and hope of reversal or get out when you get caught? The short answer is you always manage your risk and get out as soon as you possibly can if you are wrong. So how you would manage a position like this, you will have some kind of trailing stop. Now, what would that trailing stop look like? Well, it wouldn't take too much of a genius to work out, Helen, that this market, as it does this, is almost falling back on itself. It's going up so quickly, and it's highly unusual. And therefore, what you have to do with your stops is to have them vaguely in this area. I would have said would be somewhere around here. What that would be based on: 4 or 5 day trailing stop, moving average, something like that. There's a million different methodologies out there to trail things here. That you get triggered on, and maybe even look at a weekly chart or something like that. But you just have to accept that because the movement is so much, you're going to experience, you won't get the high, right? You're going to experience a significant setback that's going to kick you out of the position. But the hope is, if you owned it somewhere down here and you sold it somewhere up here, you're still doing quite well, right? Okay. What I want to talk to you next is when things don't go right. Okay, so we've seen what happens when markets trend. What I want to do now is talk to you about what happens when markets reverse. Now, why is this interesting? Well, it's really important. As I said earlier, the best reward to risk trades that occur in the market occur when the market tries a probe above or below a previous high or low, and it fails and reverses very quickly back into the trading range again, because usually it punches out the other side. So we sort of like already have a brilliant point to predefine our risk, and we also have, to some extent, a place that we can identify to get out of positions, or certainly initial parts of those positions, as the market hits the other side of the trading range or else starts a brand new trend. So one way or the other, it gives us an opportunity to measure risk and actually measure some kind of reward, which gives us a reasonable way of being involved in the markets, whilst recognizing the fact that something is wrong. So Larry Williams, a very good mentor of mine, has often referred to them as his oops trades. Now, why they're referred to as oops trades? Well, they're sort of they're called oops because what happens is people get the wrong side of the trade and they go, oops, I've got that wrong. Which I guess is one way of looking at it. But let's be more specific and technical about it and call it a price failure, shall we? So let's give an example here. This is crude oil. It is a classic example over the last few months. For those of you that were trading crude oil at the time, many regrets about this particular trade, because I didn't get it. I only saw it after the event and was very frustrated with myself. I think Ainsley did actually have it, and there were some interesting trades that took place around it and post that. As you can see, the market set off in a rocket fuel fashion for oil and moved very quickly from what was, believe it or not, folks, only $39, which at the time seemed really expensive previously, 6 months before then, but now seems ludicrously cheap compared to where we're trading at 69 rather than 39. So let's go and look at this, right? So market was cruising along in a range. We had the bounce, the up, the down, and then the up, and then the beginning of the down again. You go, okay, right, and now we have what this bar here is a key bar. Right, this is the breakout to a new low, this red bar here. So what's happening here is the market has looked at the bottom of the trading range, which previously was about just above $37, and has gone down and closed below that level. Okay, closed below that level. So what's then happened after that? So this is essentially a breakout. It's a breakout to the downside, right? So new trend starting to the downside. Where I get interested is when it fails. And what do I mean by that? Well, it took 2 days, but after 2 days, the market tried to go lower down to $34 and then began to rally. When it crossed the high of the breakdown bar from the trading range, so the high of the breakdown bar from the trading range and reversed above that, then for me, the trade was on. Okay, for 2 days you made a little bit of money. It came back to test you, to have a look, and then it absolutely exploded. Went to the top of the trading range very quickly, and you can see how this reacted. It broke out the top and then started to come down again. So inevitably, if you had a position, you'd have been taking something off around here, if not half of the position, but you weren't tested on your stop loss, which would have been down here somewhere. I know these are big numbers, guys. Well, we used to say big numbers. This is $3 or $4 in oil, but that seems like a big number in those days. And these days, it seems to be a daily trading range. So a lot of volatility in oil at the moment. So if you had your position established around about here, this 38.24 mark, went up to trade 42, you're up $3 or $4, you'd have got out of half the position. After that point in time, you'd have then watched to see what happens. If it's come down and then reverse very quickly, the logic is it's at least going to get you back to here. So this is like a slam dunk that it goes back to the top of the trading range. Let's call it 80% probability, vaguely, that it gets back to the top of the trading range. Okay, in this instance of a failure. So that's really interesting information for us, right? So we know in all likelihood we're going to have an 80% chance of going back to the top of the trading range, right? Brilliant. Okay. But then we also want to save something up. So if you use the usual 3-unit position, which I tend to trade on my broadcast group, you will see that you'll get out of one position here, possibly two, somewhere around about here, because I would have definitely got bored after having waited for a whole week for it to go nowhere, but kept a position simply because I was in profit. And then as the market unfolded, that position then went from $40 up to $54. So from my original entry at 38, we could have gone all the way up to 54, and I haven't even bothered going off the other end of the chart, right? Maybe there was more of it. But you think about that, right? So I risked 3 to make 16. So what's that? 5 to 1? Okay. Yeah, it took a month and a half to unfold. I grant you all of that. It took a little bit of time, but that's what we have when we're trading daily charts. We're trying to put that time and energy in place, right? And that type of pattern, type of price failure gives us amazing reward to risk entry points. Let's go look at another one. We're going to flit around with different times now. Okay, this goes back a million years to 2011. Look at this one here, right? So same principle applies. This time we didn't manage to even get a close below the breakout level before we started to reverse. And again, when we took out the high of the low test bar, the market set off. And I don't recall what happened next on this. I'm not sure. Do I have the other eventual outcome? No, I don't. But what I do know is when this eventual outcome happened, it shook it all the way up to here to 12. Look at these numbers. 1298. Where's the S&P trading today, folks? Is it 4 rather than a 1 in front of that, right? We're a little bit higher than we were then. Here's a very good example in Euro US dollar, right? Back in the day. This is a 15-minute bar chart, just to prove to you can trade any time frame. Okay, market creates a small mini trading range on the 15-minute bar chart. Down, up, down, up, down, up, breakout bar, naked close up here, definitely breaking out. Oh no, back inside the range again. This low here at this point, 144.80, this area right here would have been our trade initiation point for the short. We'd have sold here and we were never tested, right? Because it would have gone up, we'd have gone down, and we'd have got on board there. We were tested a couple of times, I guess, mini test, 5, this is cents, right? This is pips, 3 or 4 pips, so a bit off a spread, right? Before it then, boom, went our way. So what was our risk? Our risk was the size of this bar here, which was 44.80 to 44.95. I love this. No volatility at all, just to prove to you that volatility sometimes doesn't happen in foreign exchange and other times as well. 15 pip was the size of our 15-minute bar chart. Okay, trade got established with a 15 pip stop loss. We'd have bought it down here, 144.80 to 144.35, which is what? So 15 pips against 55 or 45 on the downside. That's a straight 3 to 1 as it went through the bottom of the trading range, which had been profit take 1 down here, profit take 2 while it stabilized here. Final profit take in this point where you got absolutely bored of holding the position and you'd have exited and gone home. Okay, because of course, as you can see, it's quite late at night. So this is the way that this, if you think about how this is working and what's going on here, you'd have made about a 3 or 4 to 1 on a 15-minute bar chart. Okay, so any time frame this works on. Let's go look at this Euro US dollar in other situations. Okay, so again, this is a bit old, but don't worry about it. We're just trying to prove the point here. Here's our breakout bar. Here's the low of that. So it's not really at the bottom of the trading range. It's more of a testy one in the middle of the trading range. So there's our risk. Our risk is what? 39.50 to 39. I'm going to call that 25. So 25 pips, right? Look at where our reward was. What's 39.25 down to 38? Let's call it 25 because my maths isn't very good. So that's a 4-to-1 straight away as the market rolls from this price rejection all the way down, and you'd have had your journeys around here, but look at the way that that worked. And then when you got to the bottom, believe it or not, you had another breakout in the opposite direction where the market went down from a brief trading range, new low close, broke back up again, broke up here. You were never offside with this trade. It went in your favor immediately from this point on, about 138.26, something like that, and then went all the way up and ended up here at 139.10. So this is over a 15-minute bar chart over one day. You had two major trades, one short, one long. You made money out of both, okay, and it's really good risk reward. This is why I love price reversals, why they're so cool. Yes, these are canned examples. No, does it happen every day? Absolutely not. But when it does, you've got to be alive to it because it's quite important. Just to prove to you that it does happen all the time, this is a daily bar chart in Ethereum. Okay, look at what happened here, right? And this isn't a typo. Look on the right-hand side, you might see those numbers, 230. This isn't a typo. This is where Ethereum was trading a year ago, right? And you can see what the sentiment was, a little bit bearish at the time, right? So here we have our trading range. Here we have our breakout, if you like, our reversal back up, and then it reverses back on itself almost immediately. So your entry point would have been the low here. For those of you who are quick, you'd see the ring low formation up here anyway, which if it was a downtrend would be your opportunity to enter. So you may have a ringed high, have a entry point at this low bar here, but ignoring that, this is a mini range, a mini flag, whatever the hell you want to call it, right? We've broken up above, we've come back. The minute it takes out this low where the arrow's pointing there, which is the low of the breakout bar, the market has reversed and gone very quickly in the opposite direction. I don't even want to work out what that is. It's Ethereum. You only made 40%. No, 50%. In the course of a week. It still happens that the market moves 50% in the course of a week. These days the numbers are just a bit bigger and the money is a bit bigger as well too. So listen, Helen, patience. Yes, this is about making sure that you have the patience to follow through with the trade. Now, what do I mean by having the patience? Right, this is a risk management decision, right? So another whole suite. We could talk about this for hours and hours on end. We don't have hours and hours on end. We've got another 20 minutes left. I've got to talk about macro, right? But this is the key thing about this, okay, is that when you look at these price reversals, you have to have the patience to let them develop. And with those big mega trends that are going on, you've got to have the patience to hang on. I have been long of coffee since 99.50. It's trading about 150 now, and as a result of that, I'm relatively pleased with myself. I've been in and out of the market twice, and I've been in the market with bigger positions twice. I'm still hanging on literally by my fingernails, and there's not many of them left these days because coffee is going to remove most of them, right? I'm still hanging on by my fingernails to my coffee position, despite the fact that I know it's one of the most highly speculative long markets out there, because I believe it should go up to 250 eventually, but eventually means it might go back to 121st and I'd feel a fool. So my challenge is, how long can I hang on for? Will I hang on until I get a signal to reverse that long position? I might not go short because I'm still a believer in the long, right? But I might just go flat for a while. And why would I go flat? Is because it's giving me mental grief, right? And I will take the opportunity to get out of the mental grief if it hits my trailing stop. Otherwise, I will stay in. And I don't even check it every day. So I don't even look at it every day. I look at it about once every 2 or 3 days and take action, put a trailing stop in that if it gets triggered, so be it. Okay. So where are we at? Oh, yeah. Okay. So just remember, right? All of this is at the end of the day a risk management decision. You're selecting the right markets that are going to give you your trading, statistical trading edge. You're trying to get your risk management right when you enter a trade and sometimes when you exit, but that's always a challenge, especially for me. I've been working on my exits for years. And then finally, you've got to manage that trade and manage that trade account, right? So how many losers can I take before I stop trading for a little while and take a breather? How many winners can I keep having and keep having and keep having? I must press, because when the market goes cold, as it inevitably will do, that is when I don't want to be trading. When things are going well, I want to press. Okay, let's talk about, right after I've had a quick break for drink, let's talk about the global macro themes that are going on at the moment. Okay, out there are three main things happening. Hang on a second, let me just finish this one too. I need all my strength for you guys. Okay, right, so here we go. Not a single piece of alcohol in those yet. So, right, global macro themes, three key themes that are going on at the moment. Right, fiscal spending. We all get this. Ex-China. China is not spending a huge amount on their fiscal deficit, right? It is the US and the rest of G7. We all know the story wherever you live in the world, right? Everybody in Europe, everybody in America, everybody in Australasia is spending money like crazy if you're a government. Why? Because there's a pandemic and a recession around, and they want to make sure that they stay in power. To do that, they need to spend money. And support people as well too. Sorry, I might have got that the wrong way round. I can't remember. The second big thing right now that's out there is everybody believes inflation is either coming or with us. For those of you that saw the CPI print in the States this week, it seemed a bit scary at over 4%. Well, we'll have a think about scary in a minute, but actually it is, funnily enough, there is some supply chain pressures at the moment. Okay, and part of this problem is that getting things from A to B is causing a lot of grief, and people are stockpiling as a result of that. There was one article I saw the other day where a guy who makes mattresses was saying, well, I can't get the foam for my mattresses, so what I'm doing is I'm ordering double. That way, when I get it, I've got enough stock to manage it. Even though it costs me more money, I'm not bothered about that because it's still not a huge cost of my production process. I need to sell mattresses because demand is so high at the moment. So I will simply buy more supply of the raw materials to make sure I can make mattresses regardless of cost. Well, that's a little micro conversation for many of the conversations which are happening at a macro level now over the reason why there's 100 boats sitting outside Long Island Port in California, not in California, in America. It's Long Beach Port in California. And lots of boats sitting outside there. Some of the time it's because people are sick from COVID and they can't work at the docks. Other times there's just a lot of product trying to make its way down through the pipe, and the pipe isn't big enough to fit all these products through it, right? That will be resolved at some point in time. We'll talk about that in a minute. But that's in the short term is causing inflation. And finally, there's obviously the effects of the pandemic, and it varies by country. If you're in the sad case of India at the moment, and I feel for any of you, if you're living in India at the moment or have Indian relatives, it must be horrific for them right now. But it's a complete volte-face to the United States and the UK, which are coming out of lockdowns, and because a lot of people, a significant proportion of the population has been vaccinated, and those economies are getting back on their feet again. And very quickly, growth is recovering. So it's a completely different story if you're living in America or in the UK to what it is living in India. And then again, there's another story if you're living in Australia and New Zealand, because Australia and New Zealand are not at this particular moment in time experiencing anything like the problems of anybody else, because we haven't really had those pandemic outbreaks here, because we were able to lock ourselves off from the rest of the world as best we could over the course of the last 18 months. And that's proved to be a very good for the economy plan. Not if obviously you're in tourism or airlines, but the rest of the economy has done very well because asset prices worldwide have come up because interest rates have come down. So when you look at this story on the left-hand side, this is GDP growth across different nations and what's been going on. And you can see for any of them, it's like up and down, or is it all good as it is in China, but lowish? And then Japan is all over the place. Canada's sort of doing okay. The USA is sort of doing okay now and on the rebound. Europe doesn't quite know what's going on, but I think they're getting better. And, Italy is having a nightmare again. And anyway, the story goes on. You get this. I don't need to put this up. When we look at the chart on the right, one of the reasons why the story is so good, and there's lots of big black lines for Q2 21. It's because governments are spending money. Look at these budget deficits. They are going nuts. Okay. The Chinese one is actually, believe it or not, the outlier at only 13% of GDP, because they are having minor outbreaks of COVID and there's things happening there. But by and large, they've been avoiding this, but they're having to increase their fiscal spending right now because they're actually contracting credit. Their economy is not growing at all as much as it used to. And I think that'll come out in the figures. They are trying to control the growth of credit as we speak. Not so everybody else. Everybody else is going bananas. These things, people used to think you were spending a lot when you were at 5, right? Oh, now we're at 25. So crazy times, folks? Okay, so the key message here is that fiscal spending is enormous, right? But the market knows that. We'll come back to this in a minute. The inflation rate is picking up now. My contention is I'm concerned that it won't stay up, and there's already signs that it's not going to stay up. But it's very clear to see that however you look at it, inflation rates, and this is judged by break-even levels, have been going up for some time, all the way through 2020, and it's getting higher and higher. These are break-even inflation rates, which is the difference between inflation-protected securities in the UK, US, and all the other countries, and the 10-year bond yield. This isn't quite the same as CPI, but this is a predictor of where they think CPI is going to be at some point in time. Okay, the UK, which is the highest one, interestingly set at around about 3% inflation, and Japan will be the worst one down there, pretty much, yes indeed, as it always is, at pretty much zero, no matter how much money they spend, no matter how much what's their budget deficit? Oh, hang on, they're almost the worst at 26%. Look at what's happened to their CPI. Still can't get it off the ground, right? They're still sitting at zero. Where have they been for the last 30 years? Zero. Okay, so is inflation going to pick up? Good question. And then finally, you've got the effects of the pandemic, right? So this is where, if you look at this, is just in the UK, for example, this is where people have lost their jobs. Not unsurprisingly, accommodation, arts, religious, political, some wholesale, but retail as well too, a little bit in construction, and then everybody else is doing just fine, thank you, basically, throughout the whole process, or they're back to work again. And again, when you look at the impact on GDP from COVID, you can see poor India there is having a complete nightmare at the moment, whereas the USA has actually got a negative one and they're doing well. And you can then see over here on the far right the different variants and how they've all taken over. We can currently see the UK variant, which is meant to be quite a contagious one, not as more with a reasonable same mortality rate, but more contagious, is obviously now the dominant strain across the world as we look at it now, looking at March, April time. So the key message I think here about the pandemic is that it's different horses for different courses, right? Again, there's a general sense of recovery around the world as people get vaccinated, but isn't that already in the market? Oh, and just a quick shout out to the biotech industry. This is the reason why we're living in the 21st century. You didn't want to be around with Spanish flu or the smallpox flu in the 19th century, or the measles epidemic in the one before that. I forget, sometimes smallpox and measles get reversed. Every 100 years, almost to the bell, there's another major pandemic caused by an outbreak of a disease. This time around, we nailed it in 18 months. That's not bad going. And some days you've got to be amazed at what science can do. The RNA vaccine is simply groundbreaking, and I'm sure going to be good for a whole lot of other diseases. Sorry, quick intervention there, and shout out to the biotech industry. Thank God, guys, you guys are a legend in my mind. So look, where does this leave us now? Okay, well, my thought is always, by the time it sort of gets to me, maybe I'm a little earlier than some people. By the time it sort of gets to me, it's already in the market. You can't tell me that fiscal spending is not discounted by the market already. They're pretty aware that everybody is spending money. By the same token, and we'll go look at some numbers, I reckon that inflation is in the market as well too. So this sense of inflation out there, the level of enduring inflation is still open to debate, but I think there's a lot of inflationistas walking around the world at the moment calling it much, much higher, and this is the start of something spectacular. And then finally, the effects of the pandemic. I think they're pretty clear for everybody to see. We know who the winners and the losers are at the moment, and obviously this is a moving target. Poor Brazil, poor India. They're doing some things about it, but they're not as in a great space as maybe Israel, UK, USA, right? So, we know where those are. So my contention is that pretty much all of this is in the market. So fiscal spending gets a yes, inflation gets a yes. Can the pandemic effects be all in the market? Well, I think they are, but maybe there's always a surprise in store with a new hybrid variant that will be a bit more damaging. But, fingers crossed there isn't, and we get the hang of this thing really quickly. So what's interesting is that if that's the case, then really people shouldn't be surprised about what economic numbers come out. And that's exactly what's taking place at the moment. So back in July and August of last year, when the economy was recovering, the economists got this completely wrong. Right? The economy surprised the economists by its resiliency over and over and over again. That resiliency proved to be in either amazing or still good until May. And from May, people's predictions about what the world is going to look like are now becoming slightly, and I hesitate to use the word slightly, but this is going negative now, the Citibank Economic Surprise Index in the United States for sure. You're already seeing a drop in retail sales, and you're already seeing the some of the economic numbers from businesses, the diffusion indices that come out were not looking as good. So the surprises now are going in the opposite direction, and the market was expecting the economy to be recovering very quickly. It's not. Businesses aren't reporting such good news as they're expecting, right? So that's interesting. So are the economic predictions now too optimistic going forward? I wonder what that means. When I look at the amount of money that people have on margin buying stocks, this is against GDP, right? We are sitting here at crazy all-time high valuations. But then there are so many different measures in the stock market which are sitting at crazy all-time high valuations. I really can't describe to you. Every measure has been completely blown out of the water. So maybe that's interesting, but I'm not sure it's a rationale for trading these days, but it's something really important to have in the back of our mind that the stock market is very overvalued compared to history. Is it very overvalued compared to a -4% real interest rate? Well, who knows? We'll see. What's also important, now let's look at inflation. Now this is where people are thinking around inflation. So the vast majority of players expect inflation either be between, so the Fed's target is 2, right? They're saying either between 2 and 3 or 3% and more. That's 91% are expecting higher inflation by the end of 2021 than the Fed range, which is around an average of 2%. They're saying above that average. Only 7%, probably didn't read the question properly, are saying it's going to be less than 2%. So really, what does this mean? It means that pretty much the entire market has bought the inflationista argument, right? What's really interesting about that is as you see some of these ISM and PMI prices starting to go crazy, and look at this ISM here. You've got an ISM price index is rapidly expanding. Down here, we've got our core CPI. So, that's interesting. Hang on a second. So does this actually have any impact whatsoever on CPI? Well, there may be a causation in there, but as this went up, so as commodity prices or prices of goods went up, did that actually feed through to final prices? No. Did it feed through to final prices here? No. Did it feed through to final prices here? No. So this time around, it's going to feed through to final prices, is it? But this time around, when we have 8 million people more unemployed than we're supposed to have, 8 million people extra unemployed than we're supposed to have, this is going to feed through the system, is it, and create inflation? Well, good point. Okay. Then when we look at some of these speculative positions in commodity prices, let's look at them. Please don't look at the one on the far left-hand side here, because that suggests that my long position in coffee is looking a little fragile. Let's ignore that and look at all the other ones, shall we? So the oats market, poor old oats market is sitting here in the bottom. Maybe that's a rally next. But right now, there aren't many people speculating in oats. But if you look at oil and corn and sugar and soybeans and cattle and hogs, these are the size of speculative positions. Guys, everybody's bought the inflationista story. Everybody's bought commodities up. Everybody's bought this story. What happens if it's just a supply chain problem that's going to go away? That's all I'm saying. And then when you look at China and what's actually going on in China, the stock market's flatlining, the debt as a share of GDP everywhere else is going bananas, but in China it isn't. Okay, so they're going through a relative debt contraction at the moment, which is probably one of the reasons why the stock market is flatlining here and has come back off the highs. Okay, so it's not being led by a massive expansion in China. In fact, if anything, the stockpiling of commodities may be taking place in China, but they're not actually transmitting that into a better economy. And it's very difficult to do inflation without a recovery in China. And this is what I'm saying, right? Yeah, look, a lot of people lost their jobs. A lot of people have got their jobs back, but it's not where it was. Okay, so just remember these arguments when you're looking at it. There's still a lot of spare capacity wandering around in the system. Why do you think inflation will be enduring? And the key thing about inflation, right, is that the only way that you can get inflation in the economy is to have no productivity growth. Okay, productivity growth is an inflation killer. What's been going on in the States, if you look at what the economic numbers for the last 9 months is, productivity is going through the roof. So back to this argument again, that I wonder if the inflationistas have this right or if it's just a blip. And just to prove the point, really, this is the corporate spending on IT as a share of GDP, right? People are trying to do their level best to cut humans out of the equation here. Okay, and in cutting humans out of the equation, what do? Well, you improve productivity. What does that do? It doesn't mean there's any inflation. So what next, right? When you look at what the world is thinking right now, how are we doing for time? Okay, brilliant. What you look now about how the world is thinking about what's going on, okay, most people are either calling 10-year yields to be higher than where they are now. Don't forget, we're looking at 1.75, right? Is, well, 1.7 at the moment. So actually, 1.7 at the moment, right? So what's that? 80, 90% of participants expect the 10-year yield to be higher than 2%. Well, that's interesting. So why isn't it at 2% or higher if they expect it to be higher? So they're not buying bonds. So bonds aren't owned by anybody at all. So that's interesting. So in our world of sentiment cycle I talked about at the beginning, I don't know if bonds are cheap, but what I do know is nobody's got them. Right? So as an asset class, it's now underallocated and underowned. People have taken their bond holdings and put them into stocks or crypto, but mostly into stocks. And if you look on the market, because of the shape of the yield curve, that what I mean by that is the 5-year rate, 5-year bond yield in 5 years' time, we can measure that because we can look at the 1 year, the 5 year, and the 10-year, and we can look at where the 5-year is, and then we can look at where the 10-year is, and we can look at what that interest rate differential is to equal them out, right? We see we're looking at almost 2.9% for 2.8% for the 5-year yield, which, by the way, is now sitting at about 40 basis points, not 2.8. Okay, so lots of discussions there. Oh, hey guys, forgot to say, you know there's a chip shortage? Well, how about the shipments in exports from Taiwan and South Korea just in the last three or 4 months or so? They have gone off the charts, right? Just for the record, just saying, these guys are getting product out the door now. Okay, so look. If inflation is not going to make a comeback, what are the likely outcomes? Well, the commodity rally is going to peter out and potentially reverse. Are we seeing a beginning of that now? I think we are. Bonds, are they cheap? I'm going to say that they're cheap. And I'm going to say they're cheaper than everything else. Cheap is a relative term. Cheaper is probably better, right? Still relative, but probably a better way of describing it. Equity valuations are high. Will they stay high? Do you know what? It's really hard to sell stocks with a minus 4% real yield. It just is. Okay, anything you get is better. However, they've run these things up quite a long way. And so if commodities do set back, I wonder what that's going to do for all those big value trades. And do you want to go back into growth if you think interest rates are going up? Anyway, there's a discussion that we could have. And finally, especially for our friends that trade in the FX market, which is most of us, by the way, the volatility is ridiculously low right now. I mean, like seriously, seriously cheaply low for all the dislocation that's taking place in the world. And if you're trading crypto, it's unbelievably ridiculously high. Okay, so just remember that. It's just crazy high, right? Investing in crypto at this point may be a good idea, but you generally speaking, I'm scared of holding a crypto position over the weekend in case I get blown out by 10%. What's that all about? Okay, this needs to settle down before I think you're going to see real investments come back into those markets. You can't keep having a ridiculous amount of volatility and expect long-term investors to sit and hold. Proved to be the case in the past. Will it prove to be the case in the future? My suspicion is not, but then I'm often proved wrong, so who knows? This is the way I'm thinking at the moment. Okay. As always, folks, that's me done. So does anybody have any questions that they'd like to ask me? Okay, so actually there are some questions, in fact. So Helen's asked, I wonder about productivity, thinking of countries that produce like India, Aussie and New Zealand excluded. Look, productivity is a really interesting point, and I think it's really fair to say that we are going to be doing more with everybody's going to be augmented, Helen, going forward, right? So the fact that we're doing this across the world on a Zoom call that was utterly seamless to set up is a great sign that the productivity, if you like, of me being able to educate you guys is much higher than it was even 1 or 2 years ago, when the tech would have failed at some point in time and it would have just been too hard. Now it seems to be seamless. So look, the way that you escape inflation is really easy, right? Either productivity goes up or else prices stop going up. Now, my old adage always says the best cure for high prices in commodities is high prices. And I think we've seen quite high prices. You only have to go to the lumber market to think about how every forester these days is drinking champagne and canopies on the porch while he continues to watch his trees grow and cut every other one down that he possibly can because the prices are insane at the moment. The trouble is he can't ship it because, of course, you can't get transportation, but that's coming. And I think that those log jams, which, if you'll pardon the expression, the log jams in the supply chain will be removed fairly soon, I think. So, look, the outlook on the G8 currencies is volatility. I'm not very good at trying to predict where things are going to go. It would be logical to assume that if we're going to continue with an inflation and fiscal spending outlook that we're having at the moment, that the US dollar is probably going to go down, and it'll certainly go down against a lot of hard assets as a medium-term outlook. That's not a reach because we've got a ridiculous fiscal deficit and everything else. However, at the micro level, when they stop spending money, and they will stop giving stimulus checks to people, when that happens and the liquidity is reduced, I think there's going to be a reaction in all markets, and there will be a throw up that will be spectacular. So you just have to watch for that. I don't know when that's going to be or what's going to happen. And look, Helen, it doesn't necessarily mean the euro is going to go up. When you look at the dollar index about where it sits at the moment, this is a decision point. Same with the euro. It's a decision point right here, right now, okay? Within the next 2 or 3 weeks, do we then take out the old highs and keep going to the 125 point, or do we then reverse and go back to the 118 area and maybe start a new trend down with the dollar going down? The Canadian dollar has been bid up on the basis of it's a commodity-based economy. Well, if commodity prices reversed and the supply chain continues to do its thing and gets back together again, and everything is fine in the course of the next 6 months, you could easily argue that dollar CAD is a crazy level and should be back at 130, in which case it's a buy. And again, look, cable is one of those things. I'm bullish on the British economy. I think it's under-owned by everybody internationally. And as a result of that, I think it's one of those markets that you should be looking at for allocating assets to just generally. So I'm bullish on the UK. What that means against all the crosses, I'll leave up to you guys. Just have to refer to The Economist in the course of the last month or so. They've written 2 or 3 articles about the UK economy and how now everything is getting out the way, post-Brexit, post-pandemic, post. Boris Johnson's government is doing a lot of good things and spending money in the right places, and there's a recovery story here that is could be a sight to behold, because after all, we know the UK will move quicker than the rest of Europe, and so if the rest of Europe begins to recover, the UK will simply explode. So there's a leverage trade on Europe by owning the UK. Gosh, I hope I've answered all those things the best I can with the currencies. The rest of them I really can't. Dollar yen, I've got no idea. Just trade the seasonals. It tends to, the Japanese yen tends to strengthen from about July, August time through to September. So dollar yen normally, I believe, goes down around that point. And the rest of the time, I think it's pretty flat. So I can't help you apart from that one. We'll just trade it as we see it. So yes, Jira, the idea here is that I think probably the direction of the British pound against the crosses and other things is for the time being up. And yes, dollar CAD is at a 7-year low. So I will come back to you with the same question, Helen, that I ask myself all the time, is how much is in the market about the dollar CAD story? My belief is the inflationistas have bought your way into this one and own dollar CAD in massive, massive, massive amounts. Just go look at the weekly chart. So what's the potential for a 6 big figure reversal in a week, which is the reason why on my broadcast group, I am trying to buy Canadian dollars, because I quite fancy the risk reward here. If I'm wrong, I lose 60 cents. If I'm right, I make 6 big figures. Yeah, I'll take that trade. Right now, I don't know when the catalyst might be or what it might be, or even from what price level. I'll just keep trying as a trader to try and get those right. The metrics for me makes tremendous sense from a risk reward basis. Doesn't make any sense to me to be short of dollar CAD much more now, because I think you're playing with fire. US dollar is going to come down further with US 10-year. So my contention is, Lewis, actually, no, I think the opposite. I think there's a real risk here that bond yields will actually start to fall again. I think there's a depends how much you know about bonds, but the long end of the US bond market here, there's a 20 to 30% potential run up. If long bonds, so 30-year bonds rally from here, right? So yields come down, prices rise. It's one of the true stories, I think, going to be of H221. So, traditionally bonds have a seasonal bias to go down in the first half of the year and up in the second half of the year. That normally starts around the middle of July, sometime from the middle of June to the middle of July. So I would expect bond yields in the States to finish doing they're going up relatively soon, this month, next month, as inflation peaks, funnily enough, and then inflation tends to fall out of the system seasonally every year from July through to November. And funnily enough, bond yields often fall, and bonds often rise in price about the same time. So as inflation comes down, bond yields come down, right? There's a correlation there. So there's a seasonal trade that you could think about. When? Couldn't tell you. Gold, I don't know. People often buy gold because it's a protection for inflation. They buy gold because it's a flight to quality risk and protection from any other asset class. I have no idea why gold moves where it moves. What I will tell you is gold has a cost price of $1,100, and currently it's trading at 18 something. Okay, that means every gold producer is making a fortune. Are they going to be smashing it out right now and making as much gold as they possibly can? Yes. Is the demand for gold so overwhelming that it's going to simply walk through that and keep buying itself till it gets to a price level at which it will stop? Well, it did that before, up to 2000. Will it do it again? Easily. There's a lot of money that could go back into gold. It won't come out of crypto, because trust me, nobody who owns crypto wants to own gold. It's 2 different asset classes. Unless it's a professional fund manager, it's 2 different sets of people. So, look, and by the way, I can come up with any price level that you want in gold, but don't forget that it costs $1,100 to make gold. Okay, and we're a long way from that marginal cost price. So can it go to 3,000? Yeah, sure, of course it can. But at some point in time, gravity will work and they'll start producing more and more, and people will stop buying it, and it will come back down again.
the gravity in the commodity markets is always the cost of production. Right now, it's being overwhelmed by speculative long positions in just about every major commodity market. So judging it is almost impossible. We do our best. That's why we're called traders. Look, guys, copper's the same thing, right? We all know this story. Copper's meant to be a signal for the economy. I just think it's a signal for storage at the moment, and I think it's a signal for speculation. I really don't have an opinion on copper any more than I do have an opinion on any of the other commodity markets. But I encourage everybody, just Google, what does it cost to make copper? What does it cost to make gold? Give yourself a benchmark for where the market is a buy long term, right? And where it may be a sell when things are ridiculous. Okay, so this is, the cost price of something is really important, because if it hits that cost price and goes below it, people will shut off production, and then you'll have the demand supply balance restored, right? At the moment, we have just a massive amount of stockpiling going on by financial players in commodity markets worldwide. The size of it is so enormous that they can't possibly actually maintain the prices at the levels that they were at. They have to go higher because the weight of speculative positions is so big. Just bear that in mind, right? And equally, if they start to sell, the market will come off twice as quickly. So you guys know the gig. You've seen trading happen before. You know what's happening. I don't need to educate you on this stuff. Just look at the volatility. You've all seen it in crypto. This thing can go anywhere in any of these markets. Guys, look, I have to end it there. Thank you very much for your time. And as always, wherever you are, thank you very much for listening. I hope you've enjoyed this. For those people living in Singapore, I hope your lockdown is going to be ending as quickly as it possibly can. Guys, thank you very much for listening. I may see you on TTR in a few minutes' time. Thank you very much if we can wrap things up, and it's been great fun.